If you look at last year, 491.2 tons of gold were stood for delivery. If you look at what's happened so far this year, and we've had something like 18 trading sessions, 285.3 tons have stood for delivery. That is 4 times the pace of last year. In other words, this is accelerating. You would think stand for delivery, okay, they're going to deliver my gold. No, that's not what happens at all. What happens is they try and refuse to deliver you any gold. It's actually a very interesting juncture because I think the viewers to this broadcast will be aware that there have been huge, great premiums recently on COMEX futures over spot, and that has drawn in massive tonnages from London, Switzerland, and elsewhere into New York. Now, I think the big question which we need an answer to is why is it that this has happened? As always, the answer is never one very simple effect or story. It started with the idea that Trump's tariffs were going to make it difficult for gold to go in, therefore get it in ahead of the tariffs, but the tariffs would probably push the price up 10%. There might have been a little bit of that to begin with, but actually, it's rubbish. The fascinating thing about this is something which I've listened to other people. I was even listening to a broadcast by the LBMA, which I think was done about 3 or 4 days ago. And there was absolutely no mention of this factor, and that is the stands to delivery on COMEX. Now, this is something which was never really meant to happen. The idea of a future, let's say, running out of its natural cycle is that you have to pin the future at that point to the spot value. So the way you do that is you say, okay, you can close your position in two possible ways. First way is you take the contra position. In other words, if you bought it, you then sell it and close the position out. The other way, if you have bought it, is you say, right, I want to have the underlying bullion delivered. Now, the idea is that the futures market is a credit market. It's not a physical market. And it's just a tangential point, if you like. That was always the intention. But the interesting thing is that following the COVID lockdowns, the stands for delivery have mounted and mounted and mounted. And recently it has accelerated very, very rapidly. And I extracted the figures for you. If you look at last year, 491.2 tons of gold were stood for delivery. If you look at what's happened so far this year, and we've had something like 18 trading sessions, 285.3 tons have stood for delivery. That is 4 times the pace of last year. In other words, this is accelerating. Now, the stands for delivery are quite complex because, you would think stand for delivery, okay, they're going to deliver my gold. No, that's not what happens at all. What happens is they try and refuse to deliver you any gold. First of all, they make it quite complicated for you to go for the stand to delivery. And, if they can lean on you and say, look, if you're going to do this, we'll never deal with you again. It's the sort of thing that they do. A guy called Rafi Faber went through this, and it's fascinating to see the process. He just detailed the whole thing. But the interesting thing is there's a guy who worked for Sprott who tried to take delivery of silver. And this is meant to be a 5-day settlement. It took 9 months for Sprott to get the silver, which they had contractually taken by standing for delivery. 9 months. Every excuse under the sun was thrown at them. And the other thing that happens in all this, and this is what emerged, is that the big bullion banks will say, look, don't worry, we've got your gold. We've got your gold. We'll give you a piece of paper which says we've got it. You don't want to pay storage fees and all the rest of it. We'll let you off that. Look, here's a piece of paper. Look, we've got your gold for you. It's a load of rubbish. Basically, This is a credit. It's a credit note for physical, which is worth literally the paper it's written of and no more. So okay, we go back to this thing where the pace of stands for delivery has accelerated. The one thing we will note is that with the delays, of people, and I think particularly on Globex, in other words, the people who are not in America using the facility of COMEX, sort of out of hours, whatever, whatever. It was Globex is a very big part of the gold contract. I guess that these are probably the people who are standing for delivery. Now, something has scared them to say, come on, we want our stock for goodness sake, no more excuses. And of course, the pace at which the stands of delivery have been mounting has put the squeeze on the establishment. And not only that, but it's interesting, and here's a technical point which I think Michael might have noticed, and that is that while the price of gold has been rising, open interest on COMEX has been falling. I mean, it's fallen from a high. I haven't got the exact dates, but I mean, it got up to sort of just under 600,000, and it lost about 75,000 contracts on a rising price. Now, that's a bear squeeze. In other words, the establishment has been very badly squeezed. And at the other end of the telescope, you've got all these stands for delivery, people panicking. Okay, why should they panic? Well, I think there are two things which stand out to me. The first is Scott Bessent saying, we're going to set up a sovereign wealth fund and we're going to put all the Treasury's gold in the sovereign wealth fund. Okay. Now, we know that all the gold isn't there. Now, I don't have actual physical evidence, but we've got loads and loads of other evidence, circumstantial evidence, if you like, which, as far as I'm concerned, is good enough. I can't tell you how much gold is missing, but everything points to the 8,132 tons being incomplete. So the question is, from a foreigner's point of view, put yourself in the shoes of someone who's bought and stood for delivery on Globex. Is the US Treasury going to confiscate my gold to make up the difference? The answer is better get my gold out of there. So that's the first thing. The second thing is that Trump, on various occasions, has said, and it's part of his "Make America Great" thing, he wants to get the dollar down. He wants to devalue the dollar by 10% or whatever the figure is, to make create a nice competitive position for American industry. Now, again, if you're a foreigner, you're sitting here, you're seeing this, quite honestly, maverick president, who's got absolutely no, if you like, feeling for property rights when it's somebody else's property. Talk to Gaza. How does he feel about how they feel about this? Talk to the Ukrainians who just had a demand for $500 million or something. Talk to the Greenlanders. I mean, what Trump has demonstrated is that he's very keen on his property rights, but everybody else can go hang. He wants their if he's got a right to it if he wants it. So this is creating some real strains in the bullion market. And of course, the other thing is if you look at his economic policies, they really just don't add up. I mean, of what we know about them, which again is something that maybe changed a little bit by experience. But, you sort of think, well, do I really want to be part of this? All these dollars I've got and all the rest of it, I'm better off in gold. Because the whole key point about it, and I know that, we look at gold, if you like, as an investment when it's not actually, it's money. But we analyze it as if it was an investment, which is actually what Michael's doing and everybody else does. I mean, and I'm not saying it's not valid. Of course, it is a valid way of looking at it, very much so. But actually what's happening, when the People's Bank of China buys gold, it's not buying gold, it's selling dollars. And that's the key, because what's happening is it's not gold going up so much. It's the value of currencies, which are credit, tanking. And that is the key point. When everybody realizes that it's the currency going down and not gold going up, the currency is doomed. We're a long way from there. Top people like central banks and so on and so forth have got an inkling that this is the case, which is why they're adjusting their reserves. The Asians as a whole, perhaps driven partly by political vibes, whatever, are sort of getting to the same sort of conclusion. And I think you'll find that the investment establishment, which is less than 1% exposed to gold, will gradually wake up to this, perhaps from the top down, the big boys who talk to opposite numbers in other countries, central bankers and so on and so forth. They might sort of start thinking, oh my God, we better have some of this. And then, of course, you're creating the buyers. The one way you look at it, you're creating the buyers to drive the gold price higher. But the other way to look at it, which is actually more accurate, is you're creating the sellers of credit, which will drive the value of credit down relative to real legal money. And I think what we have seen in the last 2 or 3 weeks has been a very, very important inflection point. The premiums on COMEX have gone back to normal. I mean, I was looking at it before it came out. There was only something like a $10, $12 premium on the current active contract compared with spot. Nothing. I mean, it's less than 1% equivalent of a lease rate. So we're back to normal on that. But the idea that we're back to normal and therefore the establishment can go back into the market and bang it and shake out, flaky long stops, whatever. I think that is looking quite unlikely. I really do. So interesting juncture. I think we've seen a big sea change in what's going on in the markets. And of course, the other thing I might just add that the most important futures contract in the world is the gold futures contract. If that one runs into trouble, everything else does. I mean, if you look at the gold silver ratio, which is just shy of 90, that's telling us it's not being priced as money at all. If it was being priced as money, you'd be, more like the Sir Isaac Newton level of 15 times. I mean, it has some money-ness. Basically, it lost its role officially, as it were, in the 1870s, particularly when Germany went on to a gold standard from a silver standard. This was following the Franco-Prussian War. And ever since then, really, silver's role as money has been as coinage. I mean, under our gold standard of 1820 through to the First World War, silver was legal tender for up to 40 shillings, which is £2. But beyond that, it wasn't legal tender. So you can see that it retained some sort of moneyness at that stage. Now, it is being priced as an industrial metal, and it's being sat on as an industrial metal. And I've long suspected that the guilty party in terms of sitting on the price of silver is actually China. China uses it as an industrial metal. It's quite simple. China wants that price not to go up because it's nice, good, healthy margins in the photovoltaic industry and so on and so forth. So I think as a major miner, China has been able to deploy physical resources, physical silver resources, to control the market. Now, I think that's probably going to come to an end. And if I'm right, and it does come to an end, then it could be explosive. I don't think I would buy silver for that particular reason. But I think what I would do is I would look at it from the point of view that with a gold-silver ratio close to 90, I don't see that gold-silver ratio going much higher. And not only that, but then I'm sort of like treading on Michael's territory. I look at the chart and I think, my God, this chart looks really pretty good. So it's a fascinating thing because every silver bull has been sitting on it and they feel that it's just hasn't taken off, hasn't done what they expected. This is so boring. I mean, oh God, this is so boring. But I think when you get really bored with it and you think, oh, you throw in the towel, that's when it's really going to take off. And it's just got that feeling to me that it's in that sort of technical position. I mean, as a commodity, it is really quite rare. one of the things that works against the price, of course, is it's a byproduct of mining other things like copper, nickel, and so on and so forth. And therefore, the mining industry, to a large extent, aren't really interested in the price. I mean, they just, this is a byproduct, get rid of it. Boom. We're in the copper mining business. So you can see that it's had quite a lot against it. But on the other hand, if the Silver Institute is right, it's been in deficit for the last 7 years. I mean, I thought it was four until I looked at the lines a bit more carefully. And the only thing that kept it together, if you like, in sort of 5 years ago was ETFs, the ETF liquidation. But I mean, it's the sort of situation where not very much ETF demand actually could change the whole landscape for silver. So again, it's rather like gold. Everybody's missed gold, in the West, that is. We sort of think, hold on a minute, we're $3,000 and I haven't got any. What the hell's going on here? I better learn something about it. It's very much the same story for silver. And I think when silver gets away from this 33 level and starts looking 33 and a half, 34, I think people are going to sit up and take a lot of notice. So that's how I feel where it is at the moment. It's more a sort of technical come market feel, if you like, that rather than any sort of earth-shattering fundamental analysis. Well, I should add, I don't sort of do any investment at all now, and I don't really follow, sort of the broader markets. I confine myself more or less to well, really, I suppose credit flows, in that context. But I was a stockbroker from 1970 onwards. I can't help but think in in the terms we're discussing. And the one thing I would note is that the mining sector has been out of fashion for so long. I don't think any broker has got any serious research coverage in the sector. And this is why, the few big funds who are sort of stepping into that space are buying the things where, you're not going to get sacked if it doesn't make any money, like the Newmont mines and all the rest of it. But I mean, the real money to be made is obviously going to be by those people who know the industry, and who understand the geology of reserves and all the rest of it, and the language that goes with it, understands what's good management and what isn't good management. Now, none of this is really in the brokers. I mean, there are a few, specialists around, people like Rick Rule and so on and so forth, who have a pretty good grasp of this sort of stuff because they know people in the industry and all the rest of it. But it's the complete lack of research in this area, which I think is going to suddenly mean that this undervalued sector is going to find everybody rushing in at the same time trying to buy it. And as Michael said, it's bar of soap time. So it could be very, very dramatic. And of course, I mean, one of the problems you have is that when this happens, the rubbish goes up as well. You've got to be able to distinguish between the good stuff and the rubbish. And I mean, you're right. In terms of return on an investment, you're going to make a lot more money playing that game correctly than you'll ever make buying gold or silver itself. But having said that, buying gold and silver is a completely different function. You're just getting out of credit. You're still in credit if you're buying mines, because what you're doing is you're buying a management's promise to deliver value to you as a shareholder. It's a promise, it's a credit. There's a debt on one side, an obligation on one side, and you're the guy who's expecting that obligation to be fulfilled. So, that does bring in other issues. I mean, we've got a huge, great credit bubble, and it's not just confined to the markets, which Michael's mentioned, but it's general because we've had, I think, something like six bubbles since the mid 1980s when the banking system became financialized, and they've never been allowed to wash out. Like in the bad old days, a recession wouldn't last terribly long. I mean, you get a very deep shakeout. You get businesses which had too much debt, they go bust and all the rest of it, and a few banks probably go with it. But within 15 months, everything recovers. We haven't had that sort of environment. It hasn't been permitted. So it's all rolled up into a huge, great tsunami of credit, which is going to break on our shores. And when that happens, I mean, it's going to be very, very ugly. And obviously, it's going to particularly hit, the sort of the momentum stocks, the artificial intelligence stocks, the tech stocks, and also the things that go with them. I mean, Bitcoin correlates beautifully with the Magnificent Seven. It's the same cohort buying it. So, and that looks to me like it's topped out. Just looking at the chart, I haven't analyzed it too too carefully, but um, that I think is what we've got ahead of us. And so, um, I would say that from an investment point of view, the sensible thing to do is to understand that you've basically got to get out of credit. But these things don't happen overnight. It could be that the credit bubble actually doesn't pop for some time, or rather like Wall Street in 1929 to 32, you have an initial shock, you've got several months of recovery, and then it's a long, long, long descent down to it lost something like I think 85% top to bottom. So it could sort of work like that. And if it does work like that, then there will be time to make good returns in the mining sector.